everyone. Great again to be back. I said that back in November when we got to be live, and we were all excited to be back, and then we were sent back to our virtual offices for a while. So it's nice to see you all in person again, and here instead of in Toronto on this March weekend. It was a crazy task to get a talk ready today. I mean, anybody who's trying to talk about the markets right now would probably say the same thing. And so I sort of captured my thoughts based on what had been going on, what's changed in the last 2 weeks, and then what hasn't changed, and where I think that sort of leads us. So if we look way back to 2 weeks ago, we were in a very different place. People were focused on very different things, right? So the main thing from where I stand, at least, is that all eyes were on the move to tightening, and there was obsessions over whether it was going to be a 50 basis point raise or a 75 basis point raise, and expectations for that had changed dramatically in short periods of time. And that all made sense. Inflation's very strong. And there's good growth and good employment, so there's no reason to not raise rates. This was the focus, right? And the move to tightening after 12 incredibly accommodative years, it was understandable that that was the focus, because to change to tightening is a fundamental shift. It was bringing us to a place that the markets, the economies hadn't been for something like 12 years, right? So it brings up, real debt service costs in the future. It was already precipitating a shift in investor focus from sort of high spec, growth stocks, and in particular like super spec tech stocks, to value stocks. That was happening. And there, of course, there was the potential for over tightening. There was lots of hand wringing about how quickly the Fed should or should not move, and the risk of recession. This was the focus. In all of that, gold was supported. Gold rises with rate hikes, especially early in a rate hike cycle, especially also when there is strong inflation. And it supported metals as a whole, because metals generally work with inflation when inflation is being driven by growth. And metals also work when there's a focus on value and when there's supply gaps. So that's where we were 2 weeks ago. Then we had February 24th and the 2 weeks since. And obviously, a lot of things have changed and gone haywire in that time frame, right? From sitting at a resources conference, the pertinent thing to say is commodities have, of course, gone through the roof. Volatility has also gone up. It's not insane yet, but it's at 35. I mean, at the peak of the global financial crisis, it hit 80, but anything above 20 is considered a high volatility environment when I'm talking about VIX. Gold is, of course, way up. I think for me, the biggest takeaway for investors is just the inflation argument. Inflation was already strong. We got a new inflation print for February out of the US today, 7.9% year over year. That's not a surprise to anybody. We all expected that. But there had been a lot of conversation about whether inflation was nearing its top, was topping. Well, we weren't going to get dramatically higher from here, even if it took a while to come down. There was a lot of speakers of that mind, but that's not the case anymore. Inflation will stay stronger for longer. And then another key thing, I think, is that fiscal priorities have changed. We were moving to tightening. We were, talking about selling bonds. Now, there's joint euro bond issuances to the tune of billions of dollars because there's a dramatic need for that that's cropped up. And so, and then recession risk has increased. I'll speak about this more, but the Fed had a hard job 2 weeks ago. The Fed has an absolutely impossible job now. So this is what's happened. Now, I'm not going to speak at length about any of these points, because I think we've probably all been thinking about them and talking about them quite a bit, because they have been the thing for the last 2 weeks. But of course, Russia. There's no easy end to this. There's no easy exit to this. And it has changed the geopolitical landscape in a dramatic way. And that is in a way that impacts economies. And there's no way that the sanctions and the corporate moves, the massive corporate exoduses from Russia, can be reversed anytime soon. Russia has turned itself into a pariah state. And so the shipping, energy, metal, food, fertilizers, the impacts that it's having, I'm not saying that these crazy spikes. Nickel isn't going to stay where it is today for a long time, but the forces that push these things up, these forces will remain in place for a long time. Energy has been all over the news. I don't need to put up these graphs, but I was just part of painting the picture is that obviously energy costs have skyrocketed. I mean, there's thermal coal. Thermal coal is trading for more than metallurgical coal. This is the kind of insane changes that we've seen in 2 weeks. Thermal coal never trades for more than metallurgical coal, but it is right now because all of a sudden, whoa, we need coal-fired power plants because Europe needs to reduce its reliance on Russian energy. And of course, there's European natural gas, and there's Brent crude, and I can't even remember what that one on the bottom is. Oh, that's gas prices, right? That's gas prices in America. So, and I can't see apparently down to there. Maybe I need glasses. Anyways, the reason that I'm bringing this up isn't to introduce these concepts to you. You've all seen these in the news over and over in the last few days. But this is part of the inflation argument, right? Energy costs are an absolutely key component in inflation calculations, and these changes will not reverse anytime soon. Europe would love to not rely on Russian energy supplies, but that isn't a quick fix. Food and fertilizer, also really important. I mean, there's been also lots in the news about the price of wheat. That's the chart that's on top there. Russia and Ukraine produce 30% of the world's wheat. Now, we're not going to run out of wheat tomorrow. There's a fair bit of wheat around, but these impacts are not going to go away anytime soon. You know, Ukrainian farmers are not going to be able to plant their crops in the next month, no matter what happens. And, you know, ships are not going to be able to move through the Black Sea, and they're not going to take Russian cargoes. These things are going to persist. So prices had already been rising for some of these things. Fertilizer is an interesting one. I mean, Russia produces sort of 10 to 25 or 30% of the components that feed fertilizer. Prices had already been rising simply because of demand and because grain and pulse prices had gone up, which gave farmers more money to spend on fertilizer. So that's a cycle that had been feeding higher fertilizer prices anyways. And not to mention that, you know, higher natural gas prices and freight rates and all of these had been boosting fertilizer prices over the last year anyways. But I think that we're going to see a significant spike that hasn't even yet played out in fertilizer prices because Russia is essential in that market. So these are long-term effects. Now, on the specifically metals side, I've put up 4 charts that are that have seen sort of standout price moves. Obviously, there's nickel. I mean, I could have spent this whole talk on nickel, but it sort of wouldn't really help anyone. There's a big short in the nickel market, and people were squeezing this short who's a Chinese trader who runs a major nickel company, and he had predicted that nickel prices were going to come down because of new processing technologies that mean that we can create class 1 nickel from lower grade ores, blah, blah, blah. He thought nickel prices were coming down. Guess what? Russia invaded Ukraine. Russia's a huge nickel producer, and speculators. So some of the move is justified, but a lot of it is speculators saying, oh my gosh, that guy who's super short, the whale who's short in the nickel market, we're going to squeeze him. And that's what they did, and that's what sent nickel up 60% on Monday and then 90% on Tuesday. Like, the moves were just next level. Nickel has been halted ever since. We don't know when it will come to trade again. So, I mean, the nickel market is a sort of standout crazy example. But of course, you know, palladium, sorry, again, I can't see what I'm looking at. Oh, aluminum. Aluminum's an interesting one because a lot of aluminum smelters in Europe rely on Russian natural gas, not to mention shipping constraints, and then zinc is getting impacts as well. These forces are real. They're not going away anytime soon. The pariah state, the sanctions, all of these things really matter. Now, I had also mentioned at the beginning that there's another shift that really matters that has played out over the last 2 weeks is fiscal focus. So if we reach way back in our minds to, 2.5 weeks ago, the focus had been on, okay, we got to rein in inflation while we support post-COVID recovery in our economies, right? That was the goal. Now, suddenly, especially in Europe, but globally for sure, the focus is instead on transforming energy sources and pathways to reduce reliance on Russia. Huge increases in military spending. I mean, we're seeing those stated proclamations from places like Germany already, and these are big changes, right? 2% of GDP or GDP spending on the military. We haven't seen that out of Germany in a very long time. Do we think that there's going to be handouts to help citizens with food and energy bills? I mean, I think that's absolutely likely. The prices that households are having to pay to keep their houses warm right now are very, very significant. And then, of course, the need for major refugee relief and aid to Ukraine. That means that the focus on tightening, on reining in spending, on supporting economic growth in a more conventional way, that's all changed. That, of course, still persists, but there's this overlying force that is now here that's very different than what was. And so I really do think that the bottom line here is all about inflation, and we're going to see a lot more inflation. It's going to be stronger. It's going to stay for longer. And within that, central banks have lost control, right? Did they have control before? Sure, that's a philosophical conversation we could have, but a couple weeks ago, you know, the idea of tightening, helping to rein in inflation, held a lot more ground than it does today, because the forces that are driving inflation today are not something that Jerome Powell has a lot of control over, right? So that's a tough spot for central banks. And the threat of recession is also a lot higher because energy costs go higher, food costs go higher. These things really reduce discretionary spending. And so the Fed, which had a very difficult tightrope to walk 2.5 weeks ago, is, you know, really walking on a knife's edge now. So I think we're going to get fewer rate hikes, but we're going to get higher inflation. So that's an interesting setup, right? What's the main driver for gold? Well, the main driver for gold is negative real rates. And if we get higher inflation with fewer rate hikes, that is the definition of negative and falling real rates, right? So what hasn't changed? I've blathered on and on about all the things that have changed over the last 2 weeks. What hasn't changed? Well, hiking, as I've said, is way more complicated now. It's a much harder path to walk. But the Fed still has to go down that path because 7.9% inflation, which was the year-over-year print that we got this morning for the US, that steals, you know, more than half of an individual's purchasing power over 10 years. You can't let inflation sit at 8%. It's just not okay. It will create its own recession, and if you don't rein it in, it will just turn into stagflation, where you have high inflation and no growth, and then you're in the 70s and nobody wants to be in that economic setup again. So we will get rate hikes. Might we even get 50 basis points next week? I don't know. I'm sure we will get at least 25, but Powell is about as dovish as they come, and upsetting the apple cart is like abhorrent to him, even if it's the thing that he actually has to do. So I believe it will be 25 basis points, but we're going to get a rate hike. And gold gains with rate hikes. And are we now in a context where gold is attracting a lot more attention for the reasons that gold often attracts attentions? Yeah. And now we're getting the rate hike moment in time aligning with that. So I think that that's an important thing to keep in mind. Inflation was here. Inflation is getting stronger because of this geopolitical situation. I hate using such a dry word to describe it, but anyways, inflation is stronger because of it, but inflation was very real. It was very much here, and it's something that has to be dealt with, so we will get rate hikes. Within this big context, we will absolutely still get investors doing that shift that had already started, which was from growth to value. The more uncertainty you get around recession risk and inflation and all of these things, the more impetus people have to shift from high speculative growth stocks over to value stocks. That works for gold, that works for metal. We also still have, from a metals investor perspective, a significant lack of exploration spending by majors over the last decade. Sort of by definition, that's something that doesn't change quickly. And so they will have to buy projects. I mean, that is happening. I'm not saying that M&A hasn't started. We have seen some, a reasonable pace of M&A over the last few years, but that has to continue. And so that's an important force. And within that, the real driver there for majors isn't just to keep production at a certain level for to say that they did, but it's because we are in the middle of a green energy revolution. And a green energy revolution is dramatically changing the rate of demand growth for a lot of metals. I mean, the chart on the bottom there is about nickel. I mean, nickel used to just be a thing that you put into stainless steel. That's what it was. I say just, of course there were some other applications, but really it was just a thing that you put into stainless steel. That is not the driver of the nickel market anymore. Obviously, we still make a lot of stainless steel. That's how we build buildings, but batteries, 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 batteries. We can't make all the electric cars that this shift is driving us to if we don't have the nickel for batteries. I mean, I actually 10 days ago invested in a phosphate company because there isn't enough nickel in the world to make all the batteries for the electric cars, which is why companies like Tesla are shifting towards, what are they called, lithium iron phosphate batteries. They don't require nickel and they don't require cobalt. There are forces here. The green energy revolution is creating metal demand paradigm shifts, and the major miners are very aware of this. In fact, a few of the people that I spoke to who were just down at a big mining conference in Florida say that that was sort of the big theme, is that majors are acutely aware of this paradigm shift and of the need to build new projects. And so this has not changed. Majors still need to get out, they need to build more projects, and they need to fill these supply-demand gaps that are very present in multiple markets. And then the other thing, of course, that hasn't changed is that gold is a safe haven. And I mean, obviously, we've seen gold's price move dramatically in the last few days. Yes, it stepped back yesterday. I put the chart of Bitcoin up beside it. I'm not for or against cryptocurrencies. There are always competitors in the safe haven world. Every time investors are interested in safe havens, there's always alternatives. Bitcoin or cryptos are the main actor in that category today. So there's lots of headlines about, Bitcoin surged to $41,000. But if you look at the bigger picture chart, it's not acting in a standout way as a safe haven, which gold clearly is. And that's to be expected. Gold has been the safe haven for a very, very long time. And cryptos have been in existence for a blink. And it's fine, they can play a role as well, but gold is a safe haven, and there's a lot of, this black box here I sort of threw up there because someone else had written down the points that I was going to sort of put up, and I was like, oh, I'll just copy and paste that picture instead of typing them out myself. But these are the these are the points that underline that the gold safe haven trade is very real. In general, I don't like geopolitical moves as drivers for the metal price, but that's because for many years now, the geopolitical moves that have sparked gold rallies have been, shall I say, contained, right? They haven't been dramatic events that have changed the geopolitical landscape in really significant ways, the way that this Russia invasion has, at least not since the last gold bull market. So this, gold is a safe haven. This is a really important force. So there's a lot of things that have changed. There's a lot of things that haven't changed. I don't like profiting off of pain, obviously, and so I wish that we were not in this changed situation. I would have been very happy if we look back at my slide on how things were 2 weeks ago. Things were set up well. I was optimistic on gold. I thought the metals were going to do well. Things were set up. Most of the drivers that had that set up have persisted. We're still going to get rate hikes. We're still in an inflationary environment. But now, layered on top of it, Russia has reset fiscal priorities, energy pathways, and commodity prices in a manner that won't be short-lived. So it actually bolsters all of the arguments. Yes, there could be a recession or a stagflationary environment that gets in the way of the base metals argument, that could impede some of the green energy revolution, but it sure isn't going to stop the green energy revolution. That is a bigger force. That's a paradigm shift that's already happening, right? In the short term, yes, recession is a possibility. Dramatic food insecurity in the world is a possibility. Think back on where some of these things have led before. It brings us straight to the Arab Spring, right? There's things happening underway that are very real. That underlines the gold safe haven argument, sad as it may be. And for many of those metals, like copper, nickel, metallurgical coal, uranium, silver, a bunch of the PGEs, I mean, the fundamentals are strong enough here that they will survive a reset, whatever form that reset might take. And we're still going to get rate hikes, and gold rises with rate hikes. So the arguments have actually remained very strong. The last point that I just tucked onto the bottom there is that uranium is also going to go. I didn't have time in this 20-minute spiel to also run through all of my arguments on uranium. I'm certainly happy to have that conversation with anybody who's interested, but I'm very bullish on uranium. The price moved $6.50 per pound yesterday alone, which was a pretty dramatic move. So it's a crazy market out there. There's a lot that will happen over the next little while. It's very unpredictable, it's very volatile, but you know, the fundamentals all look very strong for the metals that we as resource investors are interested in.